Hey, so I did something a little different today. Pretty regularly, I check in with my lender, ask him where rates are at, where he thinks they're headed, what he's seeing in the market, just to get a pulse on what's going on. And I thought it would be cool to record our conversation, and hopefully, some of you potential buyers out there would find this interesting. Dave, hey, thank you so much for taking a minute to talk with me just today so I could just get an update at what you're seeing in the market and where rates are at, and where you think we will be headed as far as rates and home prices. So I guess the question I get asked a lot from buyers is just, hey, where are interest rates today? What can I expect to see? So what are you looking at right now?
Yeah, since the last Fed meeting, we've actually seen rates drop a little bit. So we were as high as a 5.75% interest rate. Right now, we're probably around a 4.9% interest rate. So mortgage rates are different than what the Fed does. Sometimes when the Fed increases rates, we'll actually see rates drop. Mortgages are tied to mortgage-backed securities. We've seen a decline. And Bill, I think over time, we're going to continue to see rates drop. I think coming into December or January of next year, we might be into the fours, and that's because of recession. That's because interest rates typically fall in recessionary time periods. It's good for both housing and it's good for both interest rates. It's good for housing in terms of housing appreciation.
Okay, so what you're saying is if the Fed raises rates 75 basis points again at the end of this month, it's not going to have as drastic an effect on the mortgage rate.
That's correct. Yeah, I think we might be towards the top. I think we might run again, maybe around a 5.5% interest rate. But I think over time we're going to keep coming down. What the Fed did with their raise, as you and I have talked about, is they basically tried to kill inflation. Inflation is too few dollars chasing too little goods, too many dollars chasing too little goods. That's why we're paying more at the gas station. That's why we're paying more for food prices. That's why we're paying more for a whole bucket of goods and services. But over time, there's people driving less right now. They're not eating out as often. Everyone's looking to cut back a little bit, spend a little bit less. That's going to put our economy into a recession, and that's going to be good for both interest rates and housing.
Okay, interesting. How will going into a recession be good for housing and interest rates?
Excellent. Let me show you a couple charts, and these are some things that you and I have talked about before, but I put together a couple charts. Historically speaking, if we go back, anytime there's been a recession, we've seen better interest rates. I'll click through a couple of these. Back in 2020, with COVID, we dropped from 3.75 down to 2.75. In 2008, we went from 6% down to 4.875. 2001, we went from 7.375 down to 6.75. The drops were a little bit steeper in the 90s. In the 80s, we saw interest rates drop from 18% to 13%. And early 80, we saw 1980, we saw 16% down to 11.75%.
Wow. Okay.
Let me show you this slide. This one is the answer to a lot of what you're probably getting asked. Should I wait for home prices to come down? Isn't it going to be fewer dollars, fewer people having good paying jobs? Maybe we'll see some layoffs with the recession. What happens to home prices during a recession? In this graph, the recessionary periods are marked by these blue lines, the big blue lines. So in 1960, we saw home prices come down just a little bit. 1970, we saw a recession, home prices ticked up. Right around 74, we saw home prices tick up. In the 80s, during those recessionary periods, and this is a really high interest rates, we saw home prices increase. In the 90s, when we were in recession, we saw home prices increase. Right around 2001, 2002, we saw it. The only time we've seen down, and that's that blue line right around 2007, 2008, was when mortgage caused the mortgage mess, mortgage caused the recession. That was the time that we saw home prices come down during a recessionary period. If we go to COVID, which was the one I was most surprised about, people were sitting in homes. You couldn't go see the home. You were seeing it online, and people were still driving up home prices. And then
Yeah.
here's a little chart through the rest of last year after COVID, after people were able to come back into homes, home prices actually went through the roof. Let me just give you a little context here. And if you would have listened to CNBC in 2010 and they told you now is the worst time to possibly buy a home, you would have missed huge increase. Home prices almost doubled from 2010, 2012 to today, if not just a little bit more than 100% increase. If you would have listened to them in 2015, if you would have listened to them in COVID time, you would have missed some dramatic increases. All just to say, today is a totally different day than we were in 2007 when mortgage caused it because of the number of poor quality mortgages. Now, we're seeing record low inventory. And let me just show you where we're at in terms of inventory. My number here, 870,000 homes. We had 870,000 homes, the lowest ever on market at the end of 2022. This little blue line here going across, average 2.5 million homes. That's how many homes we need to be in equilibrium. So where supply and demand are equal is around 2.5 million homes. Where we're currently at, more homes have come on the market recently. We're about 1.1 million homes, but we're nowhere close to the 2005, 2007 peaks that we saw. Around then, we were looking at 3.7 million homes, and that's why home prices tumbled so quickly. That and a whole bunch of other policy changes and such. But we're a far way off from the 2.5 million homes that we need to see home prices and demand and supply all kind of line up and kind of moderate there.
Okay.
Yeah.
Oh, go ahead.
I was just going to show you one more slide and then we'll wrap this part up. But right now, and as compared to 2007, 2021, we've got about 14 million more households with almost 3 million fewer homes than we did in 2007. So we're looking at, well below 3 million fewer homes on the market right now, with about 14 million more households chasing those homes. We're going to have increase in home prices, my personal opinion, for a while. We might moderate here for a little bit. We might come down just a little bit because buying a home is also emotional. It's, how do I feel about this? Do I want to jump into the market? It's not all just a head decision as you and I are talking about right here. But once the supply and demand, once the economics jump back in and start driving the market like they did in 2021, 2022, even during COVID, my personal opinion is you're going to see home prices go back up.
Yeah. Yeah, I think the 2008 recession is still so fresh in so many people's minds that they think, oh, I'm seeing stock market go down. I'm hearing talk of recession, this, that. Home prices have got to crash, and I don't want to be a part of that again because of so many people. When you break it down like you just did, and I've kind of been doing similar things for my clients, really just showing supply and demand and trying to look at the data instead of look at the headlines. The fundamentals seem a lot safer. And I've heard a lot of people talk about this book of loans that we have on the houses that are out there currently and how it's completely different from 2008 as far as underwriting's concerned, equity. And so this wave of foreclosures isn't imminent, and we're not going to be seeing these distressed homeowners needing to get out of their house like we did back then. Is that what you're seeing too?
Yeah, 100%. So after 2008, a whole bunch of new laws came into effect. Dodd-Frank came into effect. Congress passed a bunch of laws. After 2008, it was pretty hard to get a loan for a while. Lenders didn't want to lend. There was scrutiny on everything that they did. Every appraisal was questioned. And so lending standards were really, really tight. The rules that they put into place, Congress and such, were good for housing. They were good for lending. It's now you have to qualify for a loan. Back then, you just had to show that you were a breathing person and you could get a loan. So we saw crazy stuff. Yeah. Now, in order to buy a home, you've got to qualify with what's called the debt to income ratio. The lender's going to look to see how much debt are you currently carrying, what's a new house payment going to do, what is your income, and that's going to guarantee the lender that you're going to be able to repay the loan. So lending is much, much safer now. And as a result, the number of people buying homes, those loans aren't bad loans. Those are actually some pretty good loans.
Okay, cool.
Yeah.
So if I came to you and I said, hey, Dave, I want to buy a home 12 months from now, what are some things that I should be doing today as a homeowner to prepare myself for when I'm ready to buy?
Yeah, if you're looking 12 months from now, I would start getting you ready to buy today. We'd want to start looking at your financial situation, your income. We're going to want to look at your credit docs. We're going to want to put you in a place so that when we present you to an underwriter, you're ready to go. We do a full underwrite over here on our side before you get into underwriting at the bank. Our underwrites go through same day, if not next day. The loan is fully approved on our end. So what we do with our clients, and we always recommend people contact us early in the process, we're going to start to talk to them about their dreams, their goals, their homes that they're looking for, what price range. We work with you as we've done a ton of different times. Hey, this person qualifies for this much, this is their down payment and such. You start to show them homes so that we can put that person who's maybe looking 6 months to a year into the home that they want. And we advise them, you know, if you worked on this credit score, for example, your interest rate will drop and your affordability will both go up, as well as your potential purchase price might go up. So do a bunch of different things. We just recommend that people call us early so that we can start working with them to get their financial picture all in line before we hand them over to you.
Cool.
Yeah.
That sounds great. I appreciate your time. I appreciate you sharing all this info.
I totally appreciate the time with you. And if I can do anything else for you, obviously give me a call. But just a little plug for you. I love the way you help your clients in their best interest, constantly working with them to put them in a home that's going to be a safe payment for them. One of the things that's often missed is the amount of wealth that's created through real estate. And you and I have talked a little bit, just I know you're a homeowner. I know you bought and for the purpose of creating wealth. A homeowner, as we've talked, is 44 times wealthier than a renter. And what home equity can do, both for putting kids through colleges, for whatever dream you want. I've never once had a person come to me and say, you know what, I'm so excited about buying right now. This market, I couldn't feel better in. I couldn't feel more secure. Everything, everyone's always wondering, am I paying too much for the home? What's going to happen in the future? But I love what you try and do with your clients, is showing them, here's what the future most likely looks like based upon the facts. And now let's plan accordingly. So hats off to you, Bill. Keep it up. You're doing a fantastic job, and we always love working with you. You're one of the best.
Cool. Thanks, Dave. I really appreciate it. I appreciate all your help too on all my files.
Absolutely, buddy. Hey, love these meetings, and we'll be in touch. Thanks, Bill.
All right. Cool. Thanks, Dave. Talk to you soon.